Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe Simple Sound. Today, we're diving deep into advanced U.S. equity strategies for building a robust, long term investment framework. Today's episode is based on the insightful document Advanced Topics in U.S. Equities Analysis and Long Term Strategy on safesimplesound.com website. This comprehensive guide offers a wealth of knowledge for investors looking to refine their approach and navigate the complexities of the stock market. This document emphasizes the importance of combining multiple analysis methods, not just relying on one, and stresses proactive risk management as a key to long-term success. It also highlights the power of systematic decision-making, reminding us that discipline and consistency are crucial for navigating market fluctuations. To unpack these concepts, we've structured today's episode into three key segments. First, we'll tackle the age-old debate of technical versus fundamental analysis. We'll dissect real-world scenarios like the recent Electra stock surge and the challenge of identifying a value trap versus an undervalued gem. Next, we'll explore factor investing and portfolio management strategies, examining how to balance different factors in a volatile market and the critical decision of allocating between small cap and large cap stocks, particularly in a growth market. Finally, we'll wrap up with essential risk management techniques and building your long-term investment strategy. We'll explore scenarios involving hedging against a potential market downturn and the optimal approach to rebalancing your portfolio after a market rally. So grab your notes, get comfortable, and join us as we navigate these advanced topics in U.S. equities. Let's dive in. First up is case study of a fictitious electric car company, Electra. Its stock price has surged 30% in the last month. Technical indicators like the RSI are flashing overbought signals, meaning the stock might be priced higher than its short-term trend suggests. Meanwhile, fundamental analysis, which looks at the company's actual financial performance and value, suggests Electra might be overvalued based on its current earnings. So we have conflicting signals. Sam, Taylor, what are your initial thoughts? Let's start with this. Is the price surge driven by genuine investor confidence, or are we seeing a speculative frenzy?
Wow, 30% in a month? That's a huge jump. This reminds me about momentum investing. Is that playing a role here, Sam? It feels like maybe the hype is pushing it beyond what the fundamentals justify. I'm a little confused about how to reconcile these two different perspectives.
Excellent question, Taylor. You're right to think about momentum. Sometimes a stock's price can become detached from its fundamental value due to market sentiment, news cycles, or even short squeezes. With Electra, it's a particularly interesting case because it's a company with a devoted following and a visionary CEO. This can lead to price volatility driven by speculation, sometimes detached from the underlying financial performance.
So, Sam, how much weight should we give to technical indicators versus fundamental valuation in a scenario like this? Imagine you're an investor trying to decide whether to buy, sell, or hold Electra stock right now.
It depends on your investment horizon. If you're a short-term trader, technical indicators like RSI and moving averages can be helpful tools for identifying potential entry and exit points. But if you're a long-term investor, fundamentals are paramount. Think of it like this. Technical analysis is like navigating using a map, while fundamental analysis is like understanding the actual terrain. You need both for a complete picture, especially with a volatile stock like Electra.
So if I understand correctly, a short-term trader might see the overbought RSI and consider selling, while a long-term investor might look at the company's long-term potential in electric vehicles and renewable energy and hold or even buy more despite the high price.
Precisely. And that brings us to your third point, Alex, about the risks and rewards. The reward for Electra investors could be continued growth if the company achieves its ambitious goals. The risk is that the current valuation is unsustainable, leading to a potential price correction. A counterexample might be a company with similarly high hype, but without the underlying innovation or market potential. That's a much riskier bet.
That's a crucial distinction, Sam. To recap, we've got a surge in Electra's price, technical indicators showing potential overbought conditions, and fundamental analysis suggesting a possible overvaluation. The weight you give to each factor depends on your investment timeframe and strategy.
This makes me think about the article we are discussing today, the part about combining multiple analysis approaches and not relying on just one. Looking at Electra's industry, the growth of electric vehicles and their competitive moat is important for the long-term view, right?
Absolutely. Electra's competitive moat, as mentioned in the article, comes from its technology, brand recognition, and charging infrastructure. Understanding the broader industry context is essential for a robust fundamental analysis.
Exactly. Let's wrap up this section with a key takeaway. Even with exciting growth stories like Electra, it's vital to balance the excitement with sound analysis. Both technical and fundamental factors play a role, but the weight you assign to each should align with your investment goals and risk tolerance.
This was super helpful. It clarifies a lot of my confusion about how these different approaches work together.
We're glad it was helpful, Taylor. For our listeners, a call to action. Do your own research, dig into financials, explore the industry trends, and most importantly, consider your own risk tolerance before making any investment decisions. Now, we're going to tackle a tricky scenario: the value trap versus the undervalued gem. Imagine a traditional retailer with a consistently low price-to-earnings ratio. That's the PE. Remember, the price of a share divided by its earnings per share, and a high dividend yield. On the surface, it looks like a bargain, but what if its revenue is declining and its debt is piling up? Sam Taylor, is this a value trap or a genuine undervalued opportunity?
This reminds me of what we discussed about value investing earlier in the series. A low PE could signal undervaluation, but clearly there's more to the story here. It feels like those appealing metrics might be masking some underlying problems.
Exactly, Taylor, a classic lure of the value trap. So, Sam, how can fundamental analysis help us determine the long-term viability of a business like this?
Fundamental analysis provides the tools to dig deeper. Start with the company's financial statements. Is that high dividend yield sustainable given its declining revenue? Look at the balance sheet. Is the increasing debt manageable given its current and projected cash flow? Remember the DCF, discounted cash flow analysis, we talked about? That can help project future earnings and determine a more realistic valuation.
So if I understand correctly, we're not just looking at the current numbers, but also trying to project where the company might be headed in the future. This is where understanding the industry landscape comes in, right? Like, if the retail industry as a whole is struggling, that's a big red flag.
Precisely. Sam, what role might technical analysis play in a situation like this, identifying a potential reversal, perhaps?
While fundamental analysis gives us the why behind a stock's movement, technical analysis can give us the when. Look at the stock's price chart. Are there long-term downtrends? Are moving averages confirming this decline? Is the RSI, Relative Strength Index, indicating oversold conditions? These signals can help time an entry point if fundamental analysis suggests a potential turnaround. But remember, technical analysis is a tool, not a crystal ball.
Right. It's all about combining these methods for a more comprehensive view. Taylor, how would you weigh the risks and potential rewards in a situation like this?
It's tempting to chase that high dividend yield, but the declining revenue and rising debt are huge red flags. It seems like the risk of a value trap outweighs the potential reward. This really highlights the importance of diversification. Even if the company does turn around, it's probably best not to bet the farm on it.
I agree with Taylor. A classic example of high yield, high risk. A company offering a high dividend might be doing so to attract investors and mask underlying financial troubles. Sometimes a juicy dividend is a desperate attempt to stop a sinking ship.
Great points. Let's recap. A low PE and high dividend yield can be enticing, but they don't tell the whole story. Fundamental analysis, analyzing financial statements, cash flow, and the broader industry, helps determine the long-term health of the business. Technical analysis can provide potential entry and exit points, but it's important to remember it's not a standalone solution. Finally, remember the importance of diversification.
This discussion really clarifies the dangers of value traps. I'll be much more careful about seemingly cheap stocks from now on.
Absolutely, Taylor. And for our listeners, we encourage you to go beyond these surface-level metrics. Analyze the company's financial statements, understand its industry landscape, and consider diversification as a crucial part of your risk management strategy. Next, we're navigating a tricky scenario, balancing factor investing in a volatile market driven by rising interest rates. As a refresher, factor investing focuses on specific company characteristics like value, momentum, and quality to guide investment decisions. But how do these factors behave when interest rates climb, and how can we adjust our strategies accordingly? Sam, Taylor, let's dive in. Which factors historically tend to perform well during periods of rising rates, Sam?
Generally, value and quality factors can hold up relatively well. Value stocks, being undervalued, often represent more established, profitable companies, less sensitive to rising borrowing costs. Quality companies with strong balance sheets and robust cash flows are similarly better positioned to weather economic storms often associated with rate hikes. Think of a sturdy oak tree in a windstorm. It's less likely to be uprooted than a sapling.
So, if I understand correctly, companies with less debt and steady earnings are less impacted by rising rates because their financing isn't as affected. This reminds me of what we discussed about financial ratios like the debt-to-equity ratio in a previous episode.
Exactly, Taylor. A lower debt-to-equity ratio indicates financial health, which is a key component of the quality factor.
Excellent point, Taylor. And how about momentum, Sam?
Momentum can be trickier. While a strong upward trend can persist initially even with rising rates, it becomes more vulnerable as borrowing costs increase and potentially slow down economic growth.
So, Taylor, how might you adjust your portfolio allocation in this environment to manage risk while still pursuing long-term growth?
Based on what Sam said, I'd consider tilting my portfolio slightly towards value and quality stocks. Perhaps I'd reduce my exposure to high-growth, high-debt companies that are more sensitive to interest rate changes. I might also explore low-volatility stocks, as mentioned in the pre-reading. Are those a good choice during volatile periods, Sam?
Yes, low volatility stocks can offer some downside protection in turbulent markets. However, it's important to remember that even low volatility stocks can decline in value. They simply tend to do so less dramatically than the broader market. A diversified portfolio across factors is always crucial.
That diversification is key. Now let's touch on rebalancing. Sam, what role does it play in maintaining a desired asset allocation during periods of volatility?
Rebalancing is essential. As market conditions change, your initial asset allocation can drift. For example, if value stocks outperform during rising rates, your portfolio might become overweight in that factor. Rebalancing allows you to trim back your winners and reinvest in other areas that may have lagged, maintaining your desired risk profile and potentially taking advantage of market fluctuations. This aligns with the buy low, sell high principle.
Perfect analogy. So, to recap, in a volatile market with rising rates, value and quality stocks tend to be more resilient, momentum can be more volatile, and rebalancing helps maintain your desired asset allocation. Taylor, does that make sense?
Yes, it does. So even though the article mentioned technical analysis tools like moving averages and RSI, during volatile market conditions, focusing on fundamental factors like value and quality offers a more robust strategy for long-term investors, right?
Absolutely. Technical analysis can still be helpful for short-term trading decisions, but long-term investors should prioritize the fundamentals.
Great points all around. To wrap up this section, remember that market conditions are always changing. Regularly reviewing your investment policy statement and adjusting your portfolio based on your risk tolerance, current market conditions, and these factor considerations will allow you to navigate volatility more effectively. Next, we're tackling a crucial decision for portfolio management: especially in a growth market, allocating between small cap and large cap stocks. As a reminder, small cap stocks are generally companies with a market capitalization between $300 million and $2 billion, while large cap stocks are companies with market caps exceeding $10 billion. Imagine a growth market. The economy is humming, consumer confidence is high. So, how do you decide how much to invest in potentially higher growth small caps versus the more established and often more stable large caps? Sam Taylor, let's dive in. What are the historical performance characteristics of small cap and large cap stocks during these growth periods?
Historically, small cap stocks have tended to outperform large cap stocks during strong economic expansion. This is because small companies are often more nimble and can capitalize on new opportunities faster than larger, more established companies. Think of a speedboat versus a cruise ship. The speedboat can navigate quickly changing waters much easier. However, it's important to remember that this outperformance isn't guaranteed, and past performance isn't indicative of future results.
So if I understand correctly, if the economy is booming, small caps might be expected to grow faster. But wouldn't that also mean they're riskier? Like, the speedboat might capsize in rough seas?
Exactly, Taylor. Higher potential return often comes with higher risk. Small caps tend to be more volatile than large caps, meaning their prices can fluctuate more dramatically. A large company like, say, Coca-Cola has established market share and diverse revenue streams, providing a cushion during economic downturns. A smaller, newer beverage company, even with a great product, might struggle more to weather a storm.
Excellent point, Sam. That leads perfectly to my next question. How does your time horizon and risk tolerance influence your allocation decision, Taylor?
Well, if I have a longer time horizon, like saving for retirement decades from now, I might be more comfortable with a higher allocation to small caps because I can ride out the market's ups and downs. If I need the money sooner, like for a down payment on a house in a few years, I'd probably favor the stability of large caps, right?
Precisely, your time horizon is key. Also, consider your risk tolerance. If you're easily stressed by market fluctuations, a larger allocation to large caps might be more suitable, even with a longer time horizon.
So we've talked about historical performance and the influence of time horizon and risk tolerance. What factors, Sam, should someone consider when selecting individual stocks within these categories?
Within large caps, look for companies with strong competitive moats, as we discussed before. Think established brands, innovative technologies, efficient operations. For small caps, the focus might shift towards companies with disruptive potential, those poised to become the next big thing. Due diligence is crucial here, examining their financials, management team, and market opportunity.
So it's not just about picking small cap over large cap, but also which small cap or large cap companies. This sounds more complex than just looking at market size.
Absolutely, Taylor. It's about aligning your investments with your overall financial goals and risk profile. To recap, small caps historically offer higher growth potential, but with greater volatility, while large caps provide more stability but potentially lower returns. Your time horizon and risk tolerance are crucial in deciding your allocation. And when choosing specific stocks, consider the company's fundamentals, competitive advantages, and growth prospects. As a call to action for our listeners, research current market trends and consider your long-term investment goals when deciding how to allocate between small cap and large cap stocks. Don't just chase the latest headlines, make informed decisions based on your individual circumstances. Next, we're tackling a crucial aspect of risk management within a long-term investment strategy: hedging against a potential market downturn. We've discussed diversification and rebalancing, but now we're exploring more advanced tools, specifically options and inverse ETFs. Imagine you anticipate the market might take a dip. How can you protect your portfolio without completely selling everything and potentially missing out on a rebound? Sam, Taylor, let's dive in. What are the costs and benefits of different hedging strategies like options and inverse ETFs?
Good question, Alex. Let's start with options. Think of a put option as an insurance policy on your stocks. You pay a premium for the right, but not the obligation, to sell a stock at a specific price before a certain date. If the market drops below that strike price, your put option becomes valuable because you can sell your stock at the higher strike price, limiting your losses. The cost is the premium you paid. Conversely, if the market goes up, the option expires worthless and your insurance premium is lost.
So, if I understand correctly, with put options, I'm paying for downside protection. What about inverse ETFs?
Inverse ETFs are designed to move in the opposite direction of a specific index. If the S&P 5000 drops 1%, an inverse S&P 500 ETF theoretically aims to gain 1%. This can be a simpler way to hedge than individual put options, but they can be more volatile and aren't suitable for long-term holding due to the way they're structured. They can also have higher expense ratios than traditional ETFs.
That's a great point, Sam. The costs involved bring us to my next question. How can someone determine the appropriate level of hedging for their portfolio? This reminds me of position sizing, where we discussed not over-concentrating in any single asset.
Right? Like not putting all your eggs in one basket. So, with hedging, are we essentially deciding how much insurance to buy based on our risk tolerance? Is there a rule of thumb?
Not exactly a rule of thumb, Taylor, but a framework. It depends on your individual risk tolerance, time horizon, and market outlook. If you're very risk-averse and expect a significant downturn, you might hedge a larger portion of your portfolio. However, if you have a longer time horizon and believe the dip will be short-lived, a smaller hedge might be sufficient. It's also crucial to consider the cost of the hedge. Overhedging can eat into your returns if the market moves sideways or upwards.
That's the perfect segue into my final question about the downsides of overhedging. Sam, can you elaborate on that with a practical example?
Certainly. Let's say someone invests $10,000 and hedges 50% of their portfolio with put options that cost $500. If the market stays flat, they've lost that $500. If the market goes up 10%, their unhedged portion gains $500, offsetting the option cost, but they've missed out on potential gains on the hedged portion. This highlights the importance of finding the right balance.
So, if I'm understanding correctly, overhedging is like buying too much insurance. You're paying a lot for protection you may not need and potentially limiting your upside.
Precisely, Taylor. Excellent summary. To recap our discussion on hedging, we explored options and inverse ETFs as tools to mitigate downside risk. We discussed the importance of aligning your hedging strategy with your risk tolerance, time horizon, and market outlook, while also being mindful of the costs involved and the potential drawbacks of overhedging. Before we wrap up, remember, hedging strategies can be complex. Understand the risks before implementing them, and don't hesitate to consult with a financial advisor if you need personalized guidance. Now, let's tackle a common yet crucial scenario: rebalancing after a market rally. Let's imagine your portfolio has significantly outperformed the market, particularly driven by a surge in tech stocks. Now your tech allocation is well above your target. What do you do? Sam, Taylor, let's dive into some of the practical considerations around this. First, what are the tax implications of rebalancing?
That's a great question, Alex. It's easy to get caught up in the excitement of gains and forget about the tax man. I heard about tax loss harvesting. Is rebalancing similar?
Similar in that taxes are a factor, Taylor, but with rebalancing, you're likely realizing gains, not losses. Selling those appreciated tech stocks to bring your portfolio back to its target allocation will trigger capital gains taxes. Short-term gains, if you held the assets for less than a year, are taxed at your ordinary income tax rate. Long-term gains, for assets held longer than a year, are taxed at a lower, more favorable rate.
So, if I understand correctly, a significant rally could mean a potentially hefty tax bill if I need to rebalance.
Exactly. And that leads us to the next question. What are the potential risks and benefits of delaying rebalancing?
Well, a benefit might be avoiding those immediate taxes. But what are the risks? Doesn't the article mention something about maintaining your target asset allocation?
You're right, Taylor. The risk of delaying is that your portfolio becomes increasingly concentrated in a single sector, in this case, tech. Remember our discussion on correlation analysis? If tech takes a downturn, a heavily concentrated portfolio could suffer a much larger loss than a balanced one.
Let's use a simple example. Imagine your target is 60% stocks and 40% bonds. After the rally, it shifted to 80% stocks and 20% bonds. That increased exposure to stocks amplifies both potential gains and losses. Delaying rebalancing means you're betting big on tech's continued outperformance.
So it's a trade off between potential tax savings now and potential larger losses later. It seems like sticking to the rebalancing strategy in my investment policy statement is important, even if it means paying some taxes.
Precisely. And that brings us to our final question. How can you minimize trading costs during the rebalancing process?
There are a few ways. First, consider using tax-advantaged accounts like a Roth IRA for rebalancing. Since withdrawals from a Roth are generally tax-free, you can adjust your allocation without worrying about capital gains. Another approach is to strategically use new contributions to buy assets that are underweighted in your portfolio. For example, instead of selling overperforming tech stocks, you could direct new investments towards bonds to bring your portfolio back into balance.
That's a really practical tip, Sam. Instead of selling high and potentially triggering taxes, you're buying low and gradually rebalancing.
So, if I understand correctly, there are several ways to approach rebalancing: sell overweighted assets, buy underweighted assets, or use a combination of both. The best approach depends on factors like my tax situation and account type.
Absolutely. Let's recap. Rebalancing can trigger capital gains taxes. Delaying rebalancing increases risk by overexposing your portfolio to a specific sector. And you can minimize trading costs by using tax-advantaged accounts and strategically allocating new contributions. As always, the key is to have a plan and stick to it. Review your investment policy statement and rebalance your portfolio according to your predetermined strategy. And that concludes our deep dive into advanced U.S. equity strategies here on Safe Simple Sound. We covered a lot of ground today, from the nuances of technical and fundamental analysis to the importance of risk management and creating a robust long-term investment framework. We used the excellent article, Advanced Topics in U.S. Equities, Analysis and Long-Term Strategy, as our roadmap, touching on key takeaways like combining analysis approaches and focusing on systematic decision-making. I particularly enjoyed our discussion on the Electra stock surge scenario and how to balance seemingly contradictory signals from technical and fundamental perspectives. It really highlighted the importance of critical thinking in investing. Thank you all for listening in today. We truly appreciate you being part of the Safe Simple Sound community. For more resources and links related to today's discussion, head over to our show notes. While you're there, leave us a review and let us know what you thought of the episode. And of course, be sure to subscribe so you don't miss our next episode, where we'll be tackling understanding market risk, a crucial topic for navigating turbulent times. Until then, stay informed, stay engaged, and stay safe. This is Alex wishing you all the best on your investment journeys.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.